You're listening to Real Investor Radio with Craig Fuhr and Jack BeVier, where we cover advanced real estate investing topics to help you stay ahead of the curve in your real estate investing business.
Hey, this is Jack BeVier with Real Investor Radio. My co-host Craig Fuhr is taking his son to college today, driving down to South Carolina. So exciting day for the Fuhr family. So they won't be joining us today. But the show must go on, and I'm super excited to have the time to speak with Dan Butler, a good friend of mine. We've known each other for a long time. We're in the Real Investor Roundtable together and get to spend time with each other a couple days every 4 months or so and just talk business, talk shop, work on our businesses. And that's been a great opportunity for me to get to know Dan better and learn a ton from him. And so I was super excited that he had the time to come on the podcast and chat with us today. And hopefully, we can learn some more that helps all of our businesses. So Dan, welcome to the Real Investor Radio podcast. Great to see you, sir.
Yeah, man. Thanks for having me. I'm super excited to do this and look forward to having the conversation.
Yeah, awesome. So your business is super unique, I think, because you have a real estate business, because you were involved in a number of different businesses, not just real estate, though that was is core, and was a big piece of what you grew, and you grew it to scale. Can you talk to us just about your business history?
Sure. Yeah. Going back 20 something years, did mechanical engineering, Clemson University, was in manufacturing, actually operations. Realized I was not a good engineer. Fixing things was not my thing. Understanding it was good, but fixing was another thing. So I decided to move more towards operations. And I had a mentor in high school that owned real estate, and I would drive around with him, and I was kind of the grunt guy to help him cut the grass, put up a board on a window when it was, stuff like that, little small knickknack stuff. And I just remember just the conversations around wealth creation as an 18-year-old riding around in a truck with my mentor. So I just knew I wanted to do it, real estate, and all through the college, it was back in my mind. So then, graduated college, went to Florence, South Carolina, was traveling to Memphis, and they offered me a job about a year later. So I moved to Memphis in 1998. Did not know that Memphis was one of the top back then. I don't know where it is right now, but back then it was probably top 5 in the nation around rent to price ratios. And we're a 55% city of rentals, like the number of versus home ownership. So it's a very high percentage of rental as a percent of the parcels of housing that's available. So anyway, I just had a dual career for about 13 years. I was doing the BRRRR strategy before, I wish I came up with the acronym myself, but that's exactly what I was doing. I used a line of credit on my townhouse back then, and I would just buy one house at a time and leapfrog, buy one, fix one, refinance, buy the next one. And I made a plan back then. I can remember being on a plane to California in manufacturing to get to 300 houses free and clear by the time I was 48.
That's a hell of a goal.
Yeah. And so I made that. And then the beauty of that, and, years later, looking back to that, and I just literally told this to somebody. I mentor a lot of younger guys and gals, but just writing down the plan, and how at the other end of it, just how much other things can happen just because you stuck to like a plan to go somewhere and hold yourself accountable to get that. So out of that came a property management company, a maintenance company, a lending company, a virtual assistant business, and just other things around real estate. So anyway, that's the high level, and then we transitioned to some other stuff. I'm happy to go into that, but that's the early days to get to where we built a real estate business.
Yeah. So you got a day job early on. You got a day job, and how are you finding? You finding deals on the side? Are they like stuff you can find on the MLS at the time? What year are we in?
Yeah, that's a great question. It started in October 2001. A 19-unit apartment in a area town called Frazier. Thought I was going to make a killing. Numbers look great. but I didn't know what I was doing. I was underinsured, no renter's insurance, had a fire the first month, burned down 4 units.
Oh,
But anyway, and then I got through that, and I was like, if I can get through this, I can get through anything in real estate, kind of in my mindset. But man, I was hitting up. I just saw all these signs. I buy your house for cash, and I started just texting those guys, and because Facebook wasn't a thing back then, right?
yeah.
I mean, it was probably just starting. I can't remember the year it started, but I would just, I started with the local banks. Let me back up, and I realized that I needed to go local banks to get my money, and versus national banks. Because at national banks, I felt like I was just a number.
Mm.
They were sending off my stuff to somebody, another city that didn't know me, and whether I was going to get a line of credit or a loan from them or not. So I got local banks, and then I started working just with local wholesalers. And I would text them, "Hey, I'm ready. I need another 3-bedroom, 2-bath in this area." And I tell this same thing, like those guys don't really. Most of those wholesalers, I'm generalizing here, but most of them don't have a process to dispo their houses.
Yeah.
And so back then I would
They get
just
some under contract. They just start texting the guys that
they start texting and then try to get it moved. And
Yeah.
so then I would just be like, I'd be ahead of them. Like, "Hey man, I need a house. I'm ready." "Oh man, I'm about to put one under contract," and, I had like 10 people like that. And so I just would, that's how I, went about it. So just top of mind, pushing, and getting in front of them before everybody else, and try to get that house.
Are you doing like heavy value add or stuff that doesn't need a whole lot of work? Like what's your, what's the profile of the properties we're looking at?
Back then it was one zip code to start. And they were 3 bedrooms, 1 or 2 baths, usually $15,000 to $30,000 rehab. I mean, I kind of figured out that, you buy something cheap, you're still, say 20,000, it might need 80,000, or you buy 40,000 and it needs 30,000. You'd rather do the 30,000.
Yeah. No gold stars for doing hard work, work.
That's right. Just a lot more uh-ohs and, things that pop up on you. So yeah, probably a $30,000 rehab was kind of the norm back then.
Gotcha. So you just started Burn back in early 2000s.
Mm-hmm.
How did you avoid the trap of all the free money and inflating values in 2006? I mean, that period of time took a lot of people down.
This. I mean, I'm sure you remember me telling you the story, but like we actually took off when everybody else was going down at that point. And there's 2 reasons that I think that right off the top of my head. One is I had a great relationship with all the local banks. I was paying my notes, and I was only, they were teaching, remember this, they were teaching to buy it, fix it, get it appraised high and take some money out. And now do that 10 times a year and you're making $150,000 plus you got these 10 rentals. And my engineer head could not figure out. It's like, wait a second, I'm borrowing money to have a salary and I still got to pay it back over the next 15, 20 years. And so I didn't do that. I just would buy it, fix it, and I would just try to get whatever I had in it, back.
Mm-hmm.
So that $65,000, I would still have $35,000 of equity, right? Mm-hmm. And so I just kept doing that over and over again. And so, and then I put it on 15-year notes, which is, I mean, most people you talk to now are all 30-year DSCR notes. And
the whole market's gotten resized to that. Yeah.
Yeah. The whole market's gotten resized. And I'm like, my mentors taught me 15-year. And the reason for that was, if you pay that down for several years, you just do that. I did this the other day with another guy that I showed him a 15-year and a 13-year note. You're paying that principal down so fast. Mm-hmm. So when things happen, it's like 08 crash type situation, I had options.
Right. I
could re-amortize it. I was okay if the interest rate went up. I was safe. So, but to answer your question about 08, 06, 08, so the banks were taking all those houses back. I was one of the few because of the way I'd structured my loans, we were paying our notes on time. And so they just started calling us. I mean, it was crazy. I mean, hey, I got 5 houses. Will you take them? And they would finance the purchase and the rehab. I mean,
just they needed to move the inventory. They knew you were a good operator.
Yep. They wanted the REO off.
And you were in a, I mean, that's a good cash flow market, right? Memphis is a good cash flow market. So you could make the numbers work on a 15-year AM and, still to make the payments.
Yep.
I mean, there's a lot to talk about in there in the middle, but like just fast forward to today, is that the
Yep.
case? Like, or have asset prices moved up so that's models harder to pull off these days?
In certain areas, you can still do it.
Uh-huh.
I think it's still doable. But what I'm most fearful of is the guys that are putting 30-year notes and taking so much money out. That's come back around. You know what I mean? Like
Mm-hmm.
that
Yeah,
people
it's
are
come back around. Yeah,
flashing
exactly.
30,000, $40,000 checks. Look, I just closed my house. I refinanced, and look, I took 30,000 out. I'm like, I want to put. I'm not one of those guys. I'm like, in my back, I'm like, that's not good. Like,
Yeah.
don't do that, please. Don't
Yeah.
do that. Oh, here we go again. Oh wait, like so. I just encourage people, like, my whole goal back then, and it still is to this day, when you're talking about like that kind of model, is just break even
Mm-hmm.
and find your income some other stream while the asset pays itself down.
Yeah. I
So
had I had a meeting. I do this like this office hours kind of meeting every 2 weeks for everyone at Dominion, and probably maybe like 25-30% of the company shows up, which I'm thrilled about. And we just talk about real estate investing, like just whatever real estate investing topics. A lot of folks who work with us, didn't come from real estate investing backgrounds. They came from mortgage, resi consumer mortgage. And so, I just like, and also just lots of people have personal interest in real estate investing. So like, why not talk about it? But this last week's one was exactly what you just said. And I'm like, and that's going to be, I think the next podcast episode, we're going to talk about that. But I have this like idea of like this like Ponzi scheme. I call it a Ponzi scheme because it gets everyone's attention, right? Because, but like the idea of taking out debt that the asset doesn't actually carry, and then but talking yourself into the idea that it's like, hey, I just got a tax-free cash out. I don't get a tax bill on those cash out proceeds, and it's like relatively cheap money. I think people who would think about it, some people just think about it as, oh, there's cash in the bank, thumbs up, good. And then a little slightly more sophisticated version of that is this is cheap corporate debt, right? This is 7% corporate debt, and I can't go raise 7% corporate debt. So if I'm interested in bringing in private investors at that, I mean, the going rate on that's 8 to 12. Why wouldn't I take this cheaper corporate debt?
Mm-hmm.
But that presumes that that's okay if you can always keep that money deployed at higher returns, and you're definitionally right, like taking some risk there by bringing in that extra corporate debt. And then I think that that can still get you in trouble, right? Because you've got the deployment risk.
Yeah.
Go ahead.
Well,
Yeah.
it's good till it's not.
Yeah.
Like if DSCR, and I think y'all said something about Baltimore, like having trouble, like DSCR loans. Wasn't it Baltimore that they were saying they weren't going to do them? Or
yeah, there's a big fraud. Yeah, that happens. So a lot of the city's been redlined.
Redline, yeah. So they're not doing them. So like, if that stops, it's the same thing. The 08, that's what happened.
Exactly.
Once the bank said that pendulum swung, and I'm not going to do that loan for you anymore, you're like, oh gosh, and it'll hold for several months.
Right.
But also now you can't pay your taxes because the cash flow is not there. And then
that was the cash flow model. Exactly. Yeah, exactly. I'm like, yeah. So wait, so now substitute the word bank for investors, right? Like, oh, I'm going to get money with investors, and I'm using that new investor money to pay the debt service to the old investors. I'm like, that's called a Ponzi scheme. Like it's not as sexy when you do it with 7% corporate debt, but it's still the same idea in that you're building a snowball that's getting bigger and bigger and chasing you down the hill, and one trip and you're done. And to your point exactly, I think in Baltimore we're seeing the pause in DSCR lending, or at least pullback in DSCR lending, more stringent on the credit side, double checking those appraised values to make sure people aren't like, using weird values.
Yeah.
That is leading to some incidents of people's cash flow model getting disrupted, and they're like, I'm out, here's the keys. So we're seeing a little wave of that right now, just for exactly the reason that you pointed out, that like, if that's your cash flow model, it's good until it ain't, and then you're done.
Yeah, you're done. I'm fearful, but it's hard when we get older, as you and I, age and get wisdom of like imparting that wisdom without offending somebody because they're all just young and hungry and just getting taught these ways. And you're like, you feel
Yeah,
like grandpa, like, don't do that,
crotchety old
son.
man. Yeah.
Like the old man, don't do that, son. I told you, like, but you just see it. I mean,
Yeah.
and it's just math. I mean, like, you just do the math and like, hey, man, and intuitively they know that this is going on, that they're doing a Ponzi scheme that's going to,
Yeah, and that kind of gets to like if you believe, right, like the math is easy to understand, or it's easy to illustrate the point if you use the math where, if you invest in an asset that gives you a 6% return and and the money that you use to buy that asset costs you 7%, how much money do you make? -1%, right? Really, and then your return, your equity gets nothing, and actually your equity has to service 1% debt. That 1% gap. So like that's definitely everyone. It's obvious to everyone immediately that that's a recipe for failure eventually.
right.
But what people get screwed up is that they get the expense ratio wrong, right?
Yes.
They either don't know at all and aren't even doing the math of that. They just are been told to do a certain thing and you'll get rich doing this thing,
Yeah.
or they've run the math but they've run it wrong and they think they're investing in assets that are a 9, returning a 9 and borrowing money at 7, when the reality is they just haven't had a turnover yet, and that 9 is going to get dropped down to a 6 once
Yeah.
they get through a turnover cycle.
Yeah.
And they just, their math's just wrong, right?
Yeah.
It's
Well,
it's not the thing you don't know that gets you in trouble. The Big Short quote.
yeah.
It's the thing you know for sure that just ain't so.
Yeah.
So anyway, yeah, that's been a topical thing. I think I'm going to do we'll do an episode about that and dig deeper on that concept. But
Yeah.
so you guys, I mean, so you made it through because of discipline is what I heard.
Mm-hmm.
That's the bottom line, is that you just didn't engage in that and had then a portfolio that actually had fundamentals behind it. And then you're the only guy standing when nobody else is around.
Yeah.
I mean, that must have been fun.
And and then I would say the downside of what happened just for us was if your bank gave you 10 houses, for example, you'd have to take the good with the bad.
Uh-huh.
And so we had many years to kind of catch that back up, say 10 years of just like, oh, wow, we got 100 houses that are in a terrible area that, we had to create a system like, if a house went vacant, we would say, does it have 3 years of green or 3 years of red? And we had a system like where it's 3 years of red, we're selling it.
Mm-hmm.
And so we had to create systems around there to call off, because what was happening was, we were having houses that were pulling down the whole portfolio. We didn't even realize it. You know what I mean? Like,
Yeah. Yeah, for sure.
we'd grown so fast and took on so many houses from these banks that we had to then cull out what we had taken to get right sized on the right, properties. Because one thing I learned through that whole adventure, the last, call it 20 years anyway, but is you can't will a house to prosperity.
Mm-hmm.
And because I'm hard headed. I mean, I always be like, oh, I'm going to make that. I'm going to put bars in the window. I'm going to change the window units. I'm going to change the hard floors. It didn't matter, because if that neighborhood did not support you being there, it didn't matter what you could get a house for free and you'd still lose money.
Yeah. So like, what's your, I'd love to get your take on that philosophy of like how to cull a portfolio.
Mm-hmm.
Because I think that for example, yeah, like, hey, this thing's a dog. We just spent, we've been in the red for a couple years on this address. We should sell it because it's a dog.
Yeah.
Or other side of that coin is, well, you just invested all the money that you needed to fixing the furnace, repairing the roof, and like waterproofing the basement. And so like all the hard work's done. The thing's about to go, about to be in the black. That was just deferred CapEx. And you should have done that when you bought the thing, is all that the world's told you here. So like, don't sell that one, because its stock's about to go up. You're about to actually get a real return off of that thing.
Yeah.
And then I've also heard, hey, you do the rent buy math, kind of like other version of other side of the spectrum here is do the rent buy math. And if the property has appreciated to the point where its highest and best use is, the opportunity cost of the money that you could get from selling that house, right? Is the
Yep.
idea is that like, hey, I can sell it for $500,000. I'm only bringing in $2,300 a month. That return on assets is not very good when it's great on the 250 grand, or it's fine if on the 250 grand I have into the house, but on the 500 that I could have instead of that house, I should sell that thing.
Yep.
But then those are also the highest appreciating assets. A lot of the, have been the highest appreciating assets, more stable areas, tenancy duration is going to be long, because it's a nice area. So like, what has been your philosophy on culling the portfolio?
I think it's, it's what you said. Like if we try to like, is it operational issues or is it CapEx issues? And so one of the things that and if you look at my portfolio now, I've got like 8 different property, and we use PropertyWare, and I've got 8 different portfolios, and it's by zones of the city. One thing that we messed up early on, in my opinion, is we had them all in one portfolio. Every zip code in the city all together, and it's just hard to see the data. You know what I mean? Like,
Yeah.
so then you're really
when you're not holding for location quality. Yeah.
Yeah. So location quality, you start seeing that when a portfolio over here in this zone is really red versus this one's really green, and so that's part of it. But like to your point, if the reason it was negative last year was because of new roof, that's not the reason to sell. You know what I mean? Like you look and say, all right, your rental income matched what you should, 90% of theoretical, whatever. But if it's like operational issues where like it's just getting hammered with work order after work order, and turnover, 2 turnovers in a year, that kind of stuff.
Yeah.
So it's not as exact science, but it's better than just like just trying to hold on, like, so at least I would just, for the audience out there, just put your own process in place, take the emotion out, and just go after, like, try to get your numbers and like, use some sort of system to do that. It doesn't have to be the same system for everybody. Just pick your own system that would force you to make that decision. Does that make sense? Like,
yeah. I've taken to, I go to all the turnovers. So like, once every 2 weeks, I'll just, go 4 hours and drive around and look at it and like, look at everything as it goes vacant. And, cause I'm trying to identify like, all right, how much is this turnover going to be to bring the property up to like our renovation standard today? Certain things got renovated 15 years ago when the standard was a little bit different. Or we might have bought that property at the courthouse steps and like leased it back to whoever was there, the previous owner or the tenant who was in the house. And so like didn't get really renovated. And so that's going to be a big, I'm trying to say like, all right, how much money are we going to need to invest, right? What's the cash flow negative to get this thing back online? And, because do I really want to spend $50,000? And then the other overlay is the location. Do I really want to spend $50,000 here?
yeah.
And so we end up calling like the stuff that's going to be high CapEx turnovers in lower end locations. Both of those being like the driver being that like, I don't think that I'm going to get great tenancy duration next time, or like I have to spend a lot of money to get a great, to get the tenancy duration that I want. And I'm trying to like weed those out over time.
And I mean, would you agree with this statement? I think the real return on the investments when you sell. Like just that's
like in terms of like percentage of the IRR. Yeah,
sure. And just being able to redeploy that capital into something else, like extract it, like you were talking about earlier. Like if you bought it for 50, now it's worth 100, but you're kind of running numbers based on the 50. But you could go get 100 right now and put a 1031 or redeploy that to a higher returning, and then not have to worry about that negative cash flow that we're talking about. Like those are kind of some of the things that I've just learned. They used to call me a house hoarder, like I would just buy and hold.
Great strategy.
Yeah. And I still believe in that, but now I'm like, all right, now I start trading, you're trading up, and try to increase your, use that equity that we're talking about to go from a C to a B or B to A or, A to a commercial, so I've kind of pivoted now to just commercial. And that I've really enjoyed that piece. And I can really see bigger numbers happening when you add the value, get the rents up, sell it and then 1031 to the next one and get all that. I mean, bonus depreciation has now come back up with the big bad or big beautiful bill, whichever side you're on to
Yep.
whatever you want to call it. So,
hey, let's talk about. So, I mean, you build out the property management business. Did you for your portfolio?
right.
But you were also doing it for third parties. Is that right?
Yes.
Was that just because you wanted to afford the staff that you wanted to deliver the service level you needed to take on third party management? And is that a business that you're still in? Like, talk to me about.
Yeah.
I mean, because that's a tough business. So, like, what's been your experience there?
Yeah, no, it's super tough business, but we had gone to scale. We were, doing everything ourselves. I mean, I can tell you the days where I was picking up rent and signing leases, on the back of my truck or, just without an office. And so we realized after we'd gotten to, 300 or 400 units that we can't keep doing this. This is not sustainable, to have a life, family. And back then I was still in manufacturing actually, because I was doing dual for 13 years.
Oh wow.
And so I just realized we had to start managing for others to create the fee income, to hire the people to help manage ours as well. And so still doing that to this day. We manage about 3,500 in West Tennessee in 3 different offices, have a staff mixture of virtual and, local. And so, yeah, I mean, the thing that helps us from a third party management is that we eat our own cooking, and we are, I'm part of leasing calls, and I'm driving because, like, if my stuff's not getting leased, that means my clients aren't getting leased. So, like, what else can we be doing? So as owners and that own real estate, that's helping us drive and be on the cutting edge of whatever we can do to try to be faster, more efficient, more cost effective, all those things. So it's worked in our favor to have the scale, to get things cheaper, to get things more, faster, vendors that now are like, you're the top 2 or 3 vendor for them. You know what I mean? Like, you have their attention.
Yeah.
And so you get a lot done. So scale helps in that regard.
How have you guys grown from a staffing perspective, from an operations perspective? Like getting up to 3,500, that is a substantial property management company. I mean, is that 50 people in the office working off of whiteboards? I mean, you mentioned Propertyware, but how have you grown that, and how have you turned that into a profitable business?
Yeah, that's a great question. We used to go to all the conferences across the nation, Propertyware and NARPM and different stuff, and really learned around the virtual business about 10 years ago.
Oh yeah. Okay, so that was okay. Understood. Go ahead.
Yeah, so that's when we made a pivot. We actually met Alex Hamani. Is it Hamani?
Yeah, Hamani. Yeah.
Dallas.
Yeah, Dallas. Yeah.
Remember he was just one person in office, and all these people in India. And I met him. I sat down with one of the first RIRs. I'll never forget it. And I was like, how in the world is he doing this? He was having these guys approve vendors, at Home Depot and just all this stuff. And I went back to tell my business partner about it. He couldn't believe it, and so, but when we finally clicked, it was like, wait, you can do this. We went straight at it, and we kind of look at it like the local people are the naval officers or officers in the military, and then the virtual are more your infantry, get it done, tactical. Does that make sense?
Yeah.
So, and we use Traction for every department is using Traction to have goals, key metrics. Everybody has their number. What's your one number that you're really trying to focus on to improve the business? And so your to-dos and all that stuff and your goals should match trying to get that number up to be more effective. So
how many people now do you use to manage those 3,500?
It's probably 50.
Okay. And how many Americans versus how many offshore?
Probably 20 American, US, and then 30 virtual.
Nice.
And it's a little bit, it moves a little bit because some of our offices are now using in-house techs, for maintenance. In Memphis, we're not. Dyersburg, Jackson, we do. So Memphis, once that happens, our headcount will go up. And I believe in that model as well, just because having your own people, to be able to just go tell them right now to go to help Susie Q that's having HVAC, you know what I mean? Like just take care of people the best. I think the more you can have internally, the better, in my opinion.
Yeah. The control,
The control, that's right.
matters. Yeah.
I hate saying control because I was like, it sounds like you're a control freak, but it's not. It's more about just being the best you can be,
Mm-hmm.
and controlling it helps you. I can tell you a quick story. I went and got my HVAC, my plumbing, and my GC license because several years ago we had a HVAC contractor who switched all his gas permits, said he had done them. People moving in December can't get heat on because gas is not inspected. And I'm like, there's a book called QBQ, Question Behind the Question. It's all about personal accountability. And we had read that book, and I just really believe in the principles around it. And it's like, I can't blame him. What can I do differently? And that was the light bulb moment for me to go get my, permits or my licensing. So then I can just go pull the permit myself. I know have my team go pull it on the system, go get the contractor, go do it. And we know it's done. And so that was a pivotal piece as well.
What's that? So Question Behind the Question, that's a book you said.
Mm-hmm.
Tell me about that. What's the ideas behind it?
Just personal accountability. Instead of like, and one of the, like a lot of people say, why did this happen? Why did you do that? And it flips it and says, well, what can I do to help you with that? And it just flips the whole narrative around. Instead of a defensive conversation, I can't tell you in conversation. It's like, all right, what do you need from me?
Mm-hmm.
Well, I don't have this computer. I don't have this program. Okay, I'm gonna get you that computer. I'm gonna get that program. And I'll see you in a week.
Mm-hmm.
And then you come back next week, and it's like, you do that several iterations. All of a sudden, there's no more excuses.
Mm-hmm. Yeah,
they got to get it done. And if they're not getting it done, they're not the right person. Then that's a whole other conversation. You know what I mean? Like, to me, it's just taking the excuses off the board is what the personal accountability is like. How people get in silos in their job and like, well, that's not my role. Or an easy one would be like a front desk at an office, like, and somebody shows up and the front desk person's not there. And it's like, you would just walk by because you're not the front desk person versus, oh, wait, there's somebody here that needs some help. Right. Let me help my front desk person that's a co-employee of mine. Hey, how can I help you? And what can I go, does that make sense? Like, it just flips the narrative. And then if everybody does that as a culture, you lift up because nobody's afraid to help each other out in times of need and not putting the finger. You're more about what's the problem. You're trying to solve the problem and not focus on the person.
Mm-hmm. Yeah, I follow.
And just taking out. Anyway, so that was we had the author come and did a seminar with us, and I'm a big believer that if everybody, for your audience, like QBQ, John Miller, it's a great book.
That's cool. Thanks, man. So let's talk about the rental portfolio. You grew a lot, property management with it, and then you've gotten into lending, but you've also gotten into a number of other businesses. I'd really like to talk about that because I found that really, really interesting and unique how you've approached that. When did you start getting into non-real estate businesses?
Great question. So, philosophically, one of the things I learned early on is competitors are actually your friends. And the reason I bring that up is I had a competitor, a friend of mine, that we would go to lunch and we would just share ideas and share problems. And, at one point I had given him, I'd done Culture Index, which you're very familiar with. I'm sure a lot of people in your audience use Culture Index, but personality surveys, I'd done his whole office. I knew his people better than he did, even though I didn't know them. No, you know what I mean? Because I could see man,
talk about the dynamic, even though you
I would tell him that CFO is a debater. I'm like, that debater's not going to last. And he's great. He was a CFO of his previous company, and then a year later he's firing him because the numbers were a mess. And anyway, we gained that trust, and he had invested in a Gus's Fried Chicken. And he called me one day and said, "Hey man, my partner wants out. He's got kids going to college and private school. Would you want to buy in?" And and this is part of the whole. When I sold Crestcore and got out of that, I was kind of like, what am I going to do next? It was right about that same time when I sold the first property management company I was involved with, and I bought in for 33%. And all of a sudden the next month I'm getting a check for a third of the net profit. And I'm like, I don't know how to make chicken. I don't know these employees. But I'm a strategic partner with the operator. The operator owns a third. He's in Knoxville, Tennessee. And it was just like a light bulb moment for me to say, because you think about Rich Dad Poor Dad, the next book, cash flow quadrant, you think about the employee, self-employed, business owner, investor.
Mm-hmm.
And so that's, I had made all those
Other
rounds,
yeah.
right?
Yeah.
And so that was when I was like, oh, wow, that's the I that he kept talking about. And so I just went down this path of like, how do I scale that model to be a investor? And so what I did was I just, as we've talked about, the local banks have been my big partner for 20 something years, all the banks in Memphis. And I just went to them and said, hey, find me somebody that's 20 years, behind me. It's like a Dan from 20 years ago that low on capital, hungry, grinding, but just needs a little push, little edge, or, mainly around capital and then just advising. And so I found 3 or 4 banks gave me 3 or 4 different companies that needed that exact thing. And some of them didn't work. Some of them weren't good, too risky and whatever. But that was one of the things I looked for, was not somebody want money off the table, but somebody was going to take the money and take it from, X to Y. So like, we talked about that Pro Health, the IV healthcare clinic stuff, and they were 2 clinics, and using my money went to 5, and now self-funding. So it's just a really cool, good. And to your point, when you said at the beginning of the podcast, real estate's the catalyst to allow me to have the cash flow to do that.
Mm-hmm.
Like real estate's still the core of everything. It's just allowing me to diversify. So like when I go back to the banks now, I'm very diversified. I'm not just real estate heavy, which has been my whole life, and so I see other streams of income that can now sustain different, volatility of the market or whatever is going on, with the economy and stuff like that.
Did you ever invest in other real estate businesses? Because to me, like, I'm like, hey, it's a capital intensive business. You've got a ton of experience operating it. Or would you view that as like, hey, I already have those operations, so why am I going to spend time investing in that? Or any other reason why? Like, I've always thought, like, yeah, like find the 20-year-old version of me and provide, higher LTC, provide equity and guidance and help them build their machine. Seems like a neat idea. And I'm like pretty well, and since I know the operations of real estate, I feel like I wouldn't have big surprises there. Whereas if I went to like the idea of investing in a chicken business, like I literally don't know like what I don't know what I don't know. I have I have no idea what the chicken supply chain is or whatever, right? Like the
right.
And that scares the shit out of me. But I mean, I guess are you did you just do a ton of research to get comfortable? I'm gonna hit you with like 7 questions. Did you do a ton of research to get comfortable with those operating businesses, or did you not like the idea of doing this on the real estate side? I mean, how have you chosen which businesses you've gotten in, and how have you gotten comfortable doing stuff that's outside of real estate?
Well, I'm a philosopher profile and culture index. So I'll start there. So part of my profile, how I was, God made me, is to go try things, learn, touch the oven, it's hot, don't do that again kind of thing. And so, but my background in manufacturing really taught me around P&L analysis, balance sheet, understand operations. And so I really focused on that piece as far as any business I've looked at, and just the health of the business and where the cash flow, the accounts receivable, accounts payable. So that was more, and what I've really learned, and I've got a 1-pager that I've created for this, but like core values is most important. I start there. And then what are these in the cash flow, and like, what value can I bring? Because they're tools that I can bring and will they be a good listener, a good partner? Because I've got some that I've invested in that don't want to do what I suggest and can impart that wisdom. And so those, like I've said, well, I'll never do those again. I want people that are going to walk along with me to do the things that I've learned. But so I think that answers 3 of the 7. The real estate one, like we just merged. That's why we're at 3,500 units. We just merged, with Renshaw Property Management in March. And we would say, if we can buy property management companies in different bolt-ons within that, we will, but I feel like that's a style. Like, I don't think I would do another real estate venture, like from an operational business perspective. Does that make sense? It would just be a bolt-on to what we're doing.
What you're already doing. Yeah. It would make more sense to bolt it on. Yeah, I follow. So talking about these operating businesses, because your perspective on, the partners that you choose, and, I want to dig a little bit deeper about how you add value aside from coming with a check, important of course as that is. What you mentioned that you've used Culture Index to help with that. What are the other core values that you are focused on? And, and when you're hearing a pitch from somebody, how do you figure out fit versus not, and how do you assess the risk profile? I love Marcus Lemonis, that show, The Profit.
People process product.
And whenever you've told me about this, that's the mental image that comes to mind for me. How similar or dissimilar is it from that?
Yeah, I mean, I think, and it's just even with the lending, as we're both involved in lending, and just the when I'm looking for, when the going gets tough, the character of that person. What are they going to do in the hard times? How well are they living their life? Are they sucking the business dry? Are they really, where's the money going? Are they a good listener? Do they listen to what you're, trying to impart, and do they enact some of the stuff that you're imparting? But obviously humility, integrity, long-term partnerships, that kind of mentality versus a transactional relationship. Those are very important to me. But the other big thing I would say is I've learned to take it slow. We bought a business where the guys were pushing to close, and close this month, and we should have waited a month to get all the rest of the due diligence and stuff, finished up. And it just turns into a disaster. It creates the opportunity to have disaster. So just take it slow, get to know the person or the team, and who's part of it's what's your role? What are you doing? So for me, I don't want to be the operator. That's one thing I've learned several years ago, that's not what I want to be doing in this phase. So I want to be a trusted advisor, critique, accountability partner, capital partner, that kind of thing. So that's kind of my role that I want to kind of sit in, and just be there. One thing that the partners I do have that have come to me, and they're like, man, we just love when you pick up the phone and just talk through a problem with you and you help us solve it. And so that's where I feel like I want to be in that lane.
How much time? What's your week look like? Right, you got tons of different verticals going on here. Right. How do you manage that time? How much time a week are you willing to spend on each business?
Most of the business I'm not spending hardly any time. I mean, it's a once a month call, a once a week report. I keep one thing I learned from the banks, 4 or 5 years ago, they kept talking about global cash flow. So I keep nice spreadsheets to show all the LLCs and the revenue and the net income and the margins and my percentage of the equity that should be coming to me, so that the banks can clearly see. It's for the banks, but I've also learned it's come for me is to your point, where should I put more time or more money, or what's, oh wow, this one's struggling. We need to have a conversation. It's going, trending in the wrong direction. But the majority of my time, to be honest with you, is it's, a few hours on each business. And then the lending business probably takes the most of my time. I think I talked about that the last hour, but just because I'm still the face, I'm out there talking to clients. I'm still, but I love it because I love, one thing I did, Dan Sullivan, I did a lot of his books and podcasts. And I just learned I love doing deals. I love coaching people. Mm-hmm. lending business kind of gives me that two passions all in one. You know what I mean? Like I'm doing a deal because I'm doing a loan, but it's really their deal that I'm learning, helping build them up to create wealth. Does that make sense? Like,
Yeah, 100%. Yeah.
so I'm trying to like to step back and answer your question. The majority of my time is mentoring others, is what I would say. Like meeting with people, coaching them, trying to tell them not to do these cash out stuff, like, those kind of conversations, like I just feel like I'm trying to help people save them from themselves in some instances, but just, again, I meet with people all the time. I'm not involved with their business. They're just looking for help in their business or career decision. And so that's where a lot of my time, thankfully, the way I've set it up, majority of my time can be just, serving others and not so much in the businesses.
Yeah, I follow. What is that where the dopamine rushes are coming from these days?
Besides a cold plunge.
Nice.
Did one right before the show, actually, just to make sure I was, ready to go.
That's great. That's awesome. So what's your view on the market? Like, what do you think, are you leaning into things right now? Any macro that you're concerned about? Like, just kind of what's your outlook on the next 6 to 12 months?
I watch, the markets every day, the CNBCs, and listen to the CEOs and the different government, officials. Like Scott Bessemer was on this morning just talking about tariffs and the Fed rates and all that stuff. And I just feel like, I'm just a big believer that you never stop moving. You just might need to move your needle of what you're investing in, or like what you're buying, or you might have to make 10 offers instead of one offer. Like kind of like the stocks with dollar cost averaging. I just feel like you got to keep moving forward. Obviously protecting yourself, but I think for me, I think once the interest rates, if they move a little bit, I think we're going to see an uptick in the sales, which is going to help us all. But I don't see. I mean, the rental market, I think it's going to continue. I mean, it's good, but like I feel like there's people that are kind of in this weird, like in Memphis specifically, I could talk, like people are like living together, two families in one. And so you start this past year, you've seen like rental volume availability go up. And a lot of that's related to like people living in same households. Like it reminds me of 2008, so we got to figure out that piece. And I feel like, when the Fed guy came from Atlanta last RIR, or maybe it was 2 ago.
Yeah.
That chart they did around the affordability, that's what's scary to me. The percentage of our income that has to go to buy a house right now. What stuck out to me is because we're investors, is like, we need to keep buying houses and renting because they can't afford to and I guess I could get into a moral conversation like, well, that's not helping the system. But I mean, I'm always like, well, I'll sell anything I have to somebody who wants to own a home. I totally believe in home ownership, but like, they just can't do it right now for whatever reason. Does that make sense? What are your thoughts? What are your thoughts on the market? How would you?
Yeah. No, I'm concerned about the softness, especially now that the spring is over. I'm concerned that there's some underlying fragility because of how easy it's been to get DSCR loans, frankly. I mean, we've been a purveyor of them because, like you said, like, I'm like, hey, I'm selling, I'm selling shovels, and everyone wants to buy one. So,
right.
Hey,
I'll keep selling them. But
I am also like trying to keep tabs on like, hey, how is that going to affect the market? And are there, and no one expected to be in this higher interest rate environment for as long as we have, right? Like, remember when we were in the higher interest rate environment, right? Like the first 6-12 months of it, and it was buy the house, date the rate. Well, that didn't work out. Like that, you pretty much married that rate. There hasn't been an opportunity to, everyone thought that was a temporary business decision that they were making for a year or two. And, here we are walking into year 3 with kind of no end in sight necessarily. We're like with, not certainly.
Sure.
So, I think that there's more fragility, or there's more cracks that are starting to show. And I guess the DSCR, well, when they get appraisals wrong, right? When the appraiser gets appraisals wrong, or when someone like knowingly games the system to like choose their appraiser and then like jack that number up, that's the closest thing that I've seen to 2006, 2007 practices, which is right when I got into it. So I didn't see like you had a much better like perspective on it than I
Yeah, I mean,
did.
I was buying stuff at 8%.
Yeah.
Back in 05, 06. I mean, that's when that happened, I was just like, I was buying in like 8% interest rate before. I don't get it why everybody's freaking out.
Yeah.
But
Yeah. Yeah.
you know,
I don't understand why, or I'm surprised that we haven't seen a little bit even more softness in pricing than we have already. And I'm wondering if this winter is going to be an interesting buying opportunity because of that, because interest rates are still high and money's getting a little bit harder to come by, and everyone's savings is lower than it has been. And now the flipping market's not giving any free lunches out. Like there's no free lunches right now, right? Like it's just kind of a grind to be in real estate right now. I mean, one of the reasons I like the lending business so much is that we're the debt and not the equity, but we are still, actively buying houses in Maryland, and I got my equity hat on there, and man, that is freaking work. Like that is a harder business right now. We keep
yeah,
doing it because we have a very long-term view and of investing and being in that business. And I don't want to your point, I just think, we should just keep moving, keep adding assets, dollar cost averaging, and keep the machine running. But it's tough to make cash flow work right now in that business as a standalone. So
what do you think? Do you think DSCR? Do you think you'll see a slowdown?
I
That's the
think
one I just keep wondering. That's the biggest. If you ask me, just the one talking about the market, that's the one piece that I'm concerned about.
Yeah, I think that I think we're going to start to see some scrutiny on. I think we're going to see like tightening of the edges of the box. Like I think the edges of the DSCR box may come
You
in a
know,
little bit.
tighter,
Yeah, and I think that
like
originators
credit score increase kind of thing, and
maybe.
cash liquidity.
Yeah, maybe. I mean, we did a credit score overlay ourselves because I was having too many. Because we originate the loan, then we sell it. But one of the things, if there was any fraud at any point in the 30 years of the loan, they can make me buy that loan back if the loan purchaser discovers that there was fraud. So like, so we've always been super on heightened awareness of fraud as a risk factor, a tail risk factor for the originator. And then also there's usually 6 months of early payment default that gets put back on us. So if anybody defaults in the first 6 months, we have to buy that loan back and deal with it ourselves. It's just a risk allocation idea. Their argument is like, hey, you knew this guy, you could have known, you should have known that they were going to default early, and so we have to own that risk. And so I was getting too many early payment defaults, even though loan purchasers can or are willing to buy lower than 680 FICOs. I'm not willing to do it because they were defaulting on too high of a basis, right? And I'm only making a point on like when we're selling these things. So like if I have to foreclose and they end up getting V wrong, that's a problem for me, right? Like all of my profit goes out the window on one foreclosure, right? For 50. So anyway, so we did our own overlays for FICO is my point. And I think that's something that the industry might start to see is just more scrutiny on making sure that they get V right. So like more intelligence around the appraisal reviews is where I could see loan purchasers spending energy.
Well, the biggest concern I would say in that piece that I've seen is that there's a couple of lenders that are allowing 3-mile radius comps. And I could throw you a bunch of $1 million houses right beside some within 3 miles to a $30,000 house.
Yeah.
You know what I mean? Like, and that just.
Yeah, that's the thing in Baltimore. That was kind of one of the fundamental things that allowed that fraud to happen in Baltimore was proximity to comps. And they were going 0.6 miles away. Nothing crazy. But there's a comp on the block, like or the comp 2 blocks over. Like why'd we ignore that one to go over there? Like that it's remarkable to me that appraisers. I mean, I understand that like, I understand why, like, the argument is by the industry is like, well, we should give our members the discretion because they're the experts and they should have the discretion to choose the best comps and make that judgment call. And I'm like, yeah, I hear you. But I don't know. I'm a little bit more cynical about human nature, maybe, and incentive structures. And to me, it's like, if you didn't use a comp nearby that's very close in proximity to the subject property, I also want an explanation as to why you didn't use that one, like, because like, explain to me why you disregarded this comp a block over to go 10 blocks over. Like, and both of those should be part of the analysis, not just, oh, we just get to pretend this one didn't exist and we went over here, I feel like that's that's where, the hand waving and smoke and mirrors kind of comes into play. We're like, well, they just don't even have that conversation, and I'm like, that's an awful important conversation to not have to require.
Right.
Anyway, yeah.
A fellow local, is a friendly competitor of mine. I actually went to dinner with him last night. We were just talking about just the we're struggling with. We know the appraisers are pushing the limit, and we're doing these loans, and it's kind of like right there. I mean, you know what I mean? Like, we're following that lead, but we know that at some point that could be our house. You know what I mean? Like,
yeah. Well, that's the thing, is a lot of private lenders have gotten real comfortable the past 5 years with since the DSCR loan's been a takeout. Yeah. The first couple of years, everyone was very skeptical and was lending based off of like, no, I'm going to take this house back. What's it going to, what do I need to be in it as a rental property number? But then you just saw the exit happen over and over and over again. And after a couple of years, you're like, they're going to get a $200,000 refi and be able to take me out at 140. I'll be fine anywhere below 140, even though without that idea, you might have only lent 100. But like, to your point earlier, like, you're good until you ain't, like until the music stops.
But that's how I feel. Like, good till you're not. But I think we actually, and this I just kind of took this from a bank from years ago. We do the economic model as well, as far as like the economic cash flow to get a value based on the rents, not Section 8 rents, market rent, and make sure that if we took that house back, that we could rent it and it would cash flow, that I could actually, I always try to think of plan A, B, and C. And what the worst case, I'd take this house, go get it refinanced to keep it for myself until markets, you know what I mean? Like, pay some debt down and, markets change, have some appreciation or whatever. So,
yeah, absolutely. Absolutely. Well, Dan, I really appreciate your time today. It was a great conversation. I really enjoyed it. I was looking forward to us chatting today. So,
absolutely.
Thanks for taking the time. And if folks want to get in touch with you, how should they do that? You guys have a website, email, any contact information you're willing to share?
Man, Dan Butler 901@gmail.com. I just keep it simple. And then my phone number, 901-289-7888. It's the only number I've ever had for 25 years, and I'll keep it simple. So happy to talk to anybody that needs or just wants to talk through, ideas or issues. I love helping and coaching, and mainly, I mean, before the podcast started, I love just imparting wisdom of what not to do that I did that I wish I could have done differently. You know what I mean? Like, but I would argue, like, failures cause you to learn and grow and be wise. Like, you can't, some people get stuck and they won't do anything. And so just failing, like, there's a book by John Maxwell years ago I read, Failing Forward. Like, got to fail to learn, because otherwise you just sit on the sidelines and won't do anything. And then you look up and it's 10 years later, it's like, man, I wish I'd bought some real estate or whatever the thing that you're, thinking about doing. So.
Yeah, it's awesome. And that would be a great opportunity. I would encourage everyone to take Dan up on that offer. It's a very generous one. Sounds good, man. So thanks everybody for listening. Appreciate it. This has been Jack BeVier with Real Investor Radio. See you on the next one.